Gold is approaching a massive liquidity zone right now, and smart money is heavily preparing for the next violent algorithmic move. Listen, my bias today is strictly bearish. The main liquidity target sits right at the 40-40 structural low, and my primary setup is an ambush short. We are looking at a highly specific sequence today, a massive trap being set for retail buyers, followed by a severe bearish expansion. You need to know exactly how this is being engineered so you don't end up becoming the liquidity. So my primary focus today is a potential sell setup above key liquidity. But there is one specific condition that absolutely must happen first. Most retail traders, they're looking at the exact wrong level right now, getting repeatedly trapped in false moves. If you're looking at historical support to buy gold today, you might literally be walking right into the crosshairs. Let me show you where institutions are actually targeting, and more importantly, how we can position ourselves right alongside them. Look at how the algorithm is continuously targeting deep external sell-side liquidity pools. Prices violently penetrating multi-month support lows without offering any meaningful bounce or, premium relief. What you're witnessing here isn't random market noise. No way. It is structural order flow heavily committed to the downside, actively searching for the next floor to break. Institutions are driving the market lower with programmatic efficiency, just leaving retail buyers scrambling as every supposed support level gives way. This relentless bearish expansion is the absolute backbone of the entire trade setup we're analyzing today. Now, this isn't guesswork, this is a precise institutional roadmap. Like I said, the bias is strictly bearish, the ultimate liquidity target rests near that 40-40 level, and the primary sell zone sits perfectly at a designated retracement. The goal here is not to chase the market down as it falls, that's amateur behavior. The goal is to wait and ambush. We know the direction, we know the ultimate draw on price, and we know exactly where the optimal entry point exists before the real institutional volume steps in to crush the lows. Let's break this roadmap down further into a concrete narrative. Our daily bias is a strict bearish continuation. The immediate draw on price, basically the magnet pulling the market down, is that 4040 to 4000 corridor. But equally important is our strict invalidation level at 4088. If we see a strong sustained close above 4088, the algorithmic narrative has shifted and we kill the trade idea immediately. And the catalyst to drive this entire move? Well, that will likely be New York session volatility engineering, where specific time windows are used to inject massive volume and run stops. Above us, we've got massive, unmitigated premium arrays, specifically fair value gaps. Think of these as pockets of empty space where the market moved way too fast, leaving a pricing imbalance. Normally, price naturally wants to return and fill those gaps, but right now, smart money is completely ignoring them. Instead, the immediate draw on price is the extreme discount void resting below the 40-30 structural lows. Institutions are distributing into weakness, totally bypassing the premium gaps above to aggressively seek out that massive pool of untouched liquidity resting down below. What's fascinating is how every single minor consolidation is immediately met with a violent down-close impulse candle. The market is locked in a discount delivery mode. Any bullish attempt, any slight retracement upward, is instantly neutralized by an algorithmic ceiling. The order flow is completely dominated by bearish displacement, which means the big money is forcefully stepping in to push prices down every single time retail traders try to bid it up. This programmatic ceiling prevents any sustained upward movement and completely traps anyone trying to play a reversal. This brings us to the core concept driving this entire move: sell-side liquidity. Institutions need massive order flow to offset their massive positions, right? They can't just sell into thin air. So where do they find this necessary volume? Precisely where textbooks tell retail traders to place their safety nets, right beneath obvious structural lows. The algorithm is currently in a seek and destroy expansion mode. It is actively hunting the sell-side liquidity at the 40-40 level to fuel its programmed delivery. It's almost ironic, really. The retail safety net becomes the institutional fuel. Because of this, execution is literally everything. Selling the absolute terminal low is exactly how you become the liquidity you're trying to hunt. Instead, we have a strict three-step criteria. First, we must wait for a clear 15-minute retracement into the 4070 to 4075 fair value gap zone. Second, we wait to confirm a minor lower time frame liquidity sweep within that zone. And finally, we execute our short position only upon seeing bearish displacement. It requires ironclad discipline, guys. If the steps don't happen, there is no trade, period. Currently, the market is in a vertical sell model, pushing straight into new session lows. Smart money confirmation has not yet appeared. Executing a short here risks massive slippage and puts you directly in the path of a random retracement. Honestly, the hardest part of this strategy is simply sitting on your hands. You have to wait patiently for that premium pullback. If you jump in early out of FOMO, you are ignoring the rules. We simply observe until the algorithm engineers the precise retracement we need. Based on current market structure, there is an 80% probability that price stalls during the London to New York transition window. Why is the specific time window so potent? Well, because it's when European traders are adjusting positions and US traders are just logging on, creating a massive influx of volume and session overlap. During this transition, price is highly likely to stall, pull back into our 40-70 premium pocket, and then aggressively displace downward as the New York algorithms take over. The odds are heavily stacked in favor of this precise chronological sequence. But here's the problem. This is the exact scenario most traders are completely ignoring as they try to catch a falling knife. They see the price dropping rapidly, they look at old support levels on their daily charts, and they eagerly step in to buy. They are totally oblivious to the institutional sell program running quietly behind the scenes. This is exactly where the trap is set, and it's fascinating to see how reliably the market exploits this human instinct to just buy the dip. By attempting to buy this oversold support, retail traders are literally engineering the fresh sell stops the algorithm requires to violently push down to the psychological 4,000 level. Here is exactly how it unfolds. Phase 1, retail buys the so-called support. Phase 2, the price pauses briefly, creating a minor consolidation that gives early buyers false hope that they actually nailed the bottom. Phase 3, they confidently place their stop losses right below that pause. And finally, Phase 4, the algorithm ruthlessly sweeps those exact lows. It's a highly predictable, completely mechanical cycle of liquidity engineering. And this brilliantly illustrates how upcoming medium-impact US news will likely be utilized. We have US new home sales and crude oil inventories coming up. But the real takeaway here is how you should view economic news differently moving forward. The news isn't necessarily the cause of the move. It's just the excuse the algorithm uses to inject rapid volatility. The standard session volume will likely be used as a catalyst to trigger a rapid stop hunt upward, sweeping into intraday internal buy-side liquidity to trap early shorts before the real heavy descent resumes. This all culminates in a highly specific executable trade plan designed with a strict 0.5% risk allocation to protect your capital against those sudden, news-driven volatility spikes. We are looking to sell within that 40.70 to 46 zone. Our stop loss is firmly placed at 40.88, instantly invalidating the setup if breached. We take partial profits at 40.50 and aim for the primary draw at 40.40. This provides a highly favorable risk-to-reward ratio of roughly 1 to 2.8, which is the mathematical sweet spot for absorbing a few losses while still remaining highly profitable. To wrap up this analysis, mastering smart money concepts requires immense patience and structural awareness. For those looking to mirror this institutional style, we dive way deeper into these setups in our community resources. Also, executing these precise algorithmic trades requires a specific low-spread broker environment to catch those specific fair value gaps and avoid slippage during volatility spikes. If you enjoy institutional-style market analysis using ICT and smart money concepts, make sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these exact setups, you can find the FXTM account link in the pinned comment below. The market is flashing a clear, undeniable warning signal today, so you are left with a choice. Will you trade alongside smart money by waiting patiently for the algorithm to serve up the perfect premium array? Or will you jump in emotionally, try to catch a falling knife, and become the exact liquidity the institutions are actively hunting? The trap is set. The institutional roadmap is clear. Which side of the trade are you going to be on?